Um, we'll kick tonight off. Just an introduction on Cameron, even though I'm pretty sure most people listening will know who he is. Cameron's been an economist for over 20 years. The vast majority of that is the chief economist for ANZ, and he's also been an economist for National Bank, Treasury, and Stats New Zealand. And how many years you've been out on yourself now, Cameron?
Oh, must be about 4, maybe pushing 5. Time flies when you're having fun.
Certainly.
And the fun bit is not just economics, but I've got a few other business hats. Chaperone helping businesses with banks. I've just launched another business, Equity Release New Zealand. Sit on a couple of boards. A lot more probably a business lens around my economic analysis now that I'm out there sort of running a few shops.
Yeah, I'm interested to talk to you, I suppose, on that business side later on, because I think one of the big challenges we have in New Zealand is how hard we make it for businesses to access capital. So we'll kind of do a bit of a deep dive into things like interest rates, property market, and obviously the overall economy. For anyone who wants to ask questions of Cameron, we'll go through the presentation and leave some time at the end to get into those. So if you've got a question, please don't put it in the chat box, put it in the Q&A box, because that's what we'll be focusing on a bit later on. So to jump straight into things, I want to start on interest rates, and it's definitely been, I suppose, the focus of mortgage borrowers over the last year or so with the massive hike in rates. There was a bit of a surprise last week with the updated inflation numbers, and especially on the domestic side, that was looking a bit nasty. What's your, I suppose, opinions on how that plays out over the next little while? Because I read your article on Business Desk last week, and it sounded like you were thinking there was a bit of a chance we may still see an OCR increase next month.
Yeah, well, it's interesting, I guess to look at this through probably 3 broad avenues. So if you look at longer term interest rates in New Zealand, they're pretty heavily influenced by what happens in the United States. And the United States has seen a pretty strong economy. In the last 4 months, inflation prints have come on the strong side. So the market in the United States has pushed back from the idea that they're going to be cutting rates in 2024. The market's now starting to think that US Fed might need to hike rates. Now, that's not a central scenario, but it's a big sea change. And what we've seen in New Zealand is a little bit of the same. We've sort of followed the United States pulling back from that rapid lower rate expectations that we had 2 to 3 months ago. The second thing is that that move has been accelerated by that Q1 inflation number was absolutely bloody awful. Well, there's no other way to describe it. Your headline was coming down. But if you look at non-trade, which is the area of inflation the Reserve Bank's got the main control over, they're expecting 1.1% in the quarter. It came in at 1.6. Instead of 5.3 year on year, it's 5.8. And the Reserve Bank expressed in February and April, they said, we don't have too much tolerance for inflation surprises. So they got one. So all of a sudden you start to think it's game on, all else equal, you'd be putting a hike on the table. But then we've got factor 3. And factor 3 is that the New Zealand economy has walked into a brick wall in 2024. Late last year, it was weakening, it was softening. We were seeing negative prints for GDP, but they weren't really bad. Most firms, I think, were less busy. We've woken up in 2024 and realities set in, and all of a sudden everybody's running around scrambling for work. We're seeing what's called cancelnomics coming out of the government. So that weak economy is actually telling the Reserve Bank at the moment they probably need to cut rates and do it reasonably quickly. The problem is we've got this blurred path where the demand side of the economy is saying cut rates, but we've got all these persistent inflation pressures coming through that are saying, hang on, we're not quite sure we're on top of this thing, so we need to be a little bit more watchful going forward. So, I still think we've got a wee way off before rates move down. But if this weakness in the economy really pans out as we're expecting, they'll be in play in 2024. But when you see Air New Zealand lifting airfares, utilities, rates 15%, insurance costs probably 25%, there's a certain persistence to the inflation story that's going to make the Reserve Bank's life difficult in 2024.
Just jumping into, I suppose, a couple of the key domestic inflation, I suppose, numbers. My understanding is that rental inflation was in particular really strong. How much of that are you putting down to obviously really strong migration numbers? And how much are you putting that down to obviously landlords having to get as much cash in the door to pay for the higher mortgage, interest rate hikes? Obviously, they are still getting hit by the interest deductibility change, all that type of stuff.
Can we separate out the two effects? The short answer is no. But common sense would say that we're seeing a combination of both. When you get a migration inflow, that we've opened the door and 130,000 people have turned up. Just common sense economics suggest, now those people that are coming in, I don't think are natural buyers of houses, because the mix actually matters. But they're renters of property, and 130,000 puts an awful lot of pressure on your rental market. So lo and behold, the rental market is picked up. Now rental inflation tends to be driven by wage movements. And what we're seeing is that wages are still holding up. I think it'll be interesting the back half of this year as we start to see unemployment rates start to rise, and we start to see those job layoffs coming through. All of a sudden pushing rental increases through when you start to see wage growth start to come down starts to be a lot more challenging. But last year strong wage growth, you can push up rents.
But another factor that was, is of course, the construction costs. And where I'm interested in your opinion is we've obviously seen, as you mentioned in the article, Carter's, ramping the timber pricing. On the opposite side of that, I saw Kris Penk mentioned a few weeks ago about looking to allow building products basically from overseas. So, for example, products that which have been approved in Australia to be used over here. Do you see that having any, I suppose, deflationary impact over time?
Well, it's going to need to, because you're going back to that. Carter sent out a letter a couple of weeks ago saying timber prices are going up 6 to 9%, which in the current environment for the construction sector, you scratch the head in regard to what the hell's going on here, because the work is fading pretty quickly. Now, just an update on that, they actually pulled those price increases. The blowback was so strong on the ground that they actually withdraw those numbers. So that's actually telling us that demand conditions can actually have a pretty big impact in regard to what's going on. But you talk to plumbers, electricians out there, they're still seeing price increases for materials, and they're trying to pass them on, but the market's starting to push back really strongly. And as you start to see more competition for work, the building consent numbers have dropped, but the building consent numbers I still think are pretty optimistic on the true number. Why? Because a whole lot of people are parking projects. You can't get finance, you can't make the numbers stack up. So you hit pause. So 35,000 building consents is still optimistic in regard to what's going on the ground. So you were starting to see a bit more aggression coming into the market in regard to pricing of work. But we need to see, look, you can't just rely on beating up the economy to tame construction cost inflation. You need to see structural changes in the market. And that's where you're bringing in some of the certified offshore project stuff is actually good. If it meets the Australian standards, then it should be fit for purpose for going in a house here in New Zealand. Game on.
We were having a discussion in the office earlier about the absolute massive number of basically properties on trading at the moment with consents in place, and there's obviously developers who can't, or they can't basically develop it, or it's not feasible anymore to basically kind of obviously progress with that. So I agree with you that I think a lot of those properties won't be built.
Well, I think what's also going on is that the buyer of a whole lot of stuff, old Kianga Ora, has hit the pause button too. So they're no longer stepping out to the plate and being that big saviour like they were in late 2022 and 2023. So now you're starting to see a little bit more of an adjustment coming through land prices.
And in the article I was referencing before, kind of you said that there's probably a 1 in 3 chance that we could potentially see an OCR hike in May. I note before then that we've got the unemployment numbers coming out next Wednesday, I think it is. And then we've got a survey in regards to the expectations around inflation a couple of weeks after that. What kind of results would you have to have in those two events coming up for the Reserve Bank to hike?
So if we see wage inflation remain persistent, well, the unemployment rate's going to move up. But what we're still seeing out there is this lagged impact of high inflation. And when you got high inflation, yeah, people want to get a bit more compensation for wages, and it comes through with a 12-month lag. Yeah, so the more that we start to see, and that just adds to what's called unit labour costs. You know, wages divided by productivity. What do we know at the moment? Wage growth is pretty strong and productivity is rubbish. You know, so unit labour costs go up. And that's one of the reasons what's called service sector inflation. Yeah, that went from 4.7% to 5.3% in the March quarter. Yeah, so that's rising as opposed to going down. So the alarm bells are starting to come through. Yeah, the weak economy, I think, will dominate here because you've got an economy that, clear as day is in a full-blown recession now. And by a full-blown recession, I'm talking about a proper one. Yeah, so the hurdle to raising rates is tremendously high. Yeah, but you see that sort of miss on inflation. And if we see what's called inflation expectations, where people think inflation is going to be 2, 5, 10 years down the track, which is the epicenter of any central bank's credibility. If those numbers pop up in May, the Reserve Bank is in a real pickle because the inflation stuff will be telling them you need to dish out more economic pain. Whereas what we know there at the moment is that the economic pain is coming thick and fast. The problem is we haven't seen it come into the pricing side of the equation yet. Now, common sense would say it's going to take place the back half of this year, which I think is the central scenario. Yeah, so the probability is still greater we see a rate cut than a rate hike, but you wouldn't have a zero probability on a rate hike.
I mean, just staying on the job market, I suppose, for a couple of minutes, we've noticed even in our business, I mean, a couple of years ago, you couldn't find a good staff member no matter how you tried. Last year wasn't too bad. We've found now we're getting a lot of CVs now crossing the desk. And,
Yep.
so, and they're quality CVs, and that's a massive change within a pretty short time frame.
I spent half my life in Auckland and the other half back down here in Wellington, and it's pretty brutal what's going on in Wellington.
I was gonna ask you that question earlier. About 2 months ago, I went to the New Zealand Aussie cricket test down there, and it was a pretty dour place to go. I don't think I've ever seen Wellington so nervous. There was a lot of people obviously worried about their back pockets and their job security and all this type of stuff. And I mean, how do you see Wellington playing out over the next 24 to 48 months?
Well, just, if you look at Wellington more broadly, Wellington's always had strategic problems in regard to what's the growth plan? Where's Wellington going over the next sort of 10 years? I remember, I think John Key made some quite disparaging comments about Wellington about 10 plus odd years ago. But Wellington follows a pretty simple playbook. Wellington likes a red hui and it doesn't like a blue hui. And what we got at the moment, we've got a blue hui, so Wellington's going to underperform the national average. Wellington outperforms when we've got the Labor Party in government, and we underperform when we've got the National Party in government. It's not rocket science because one spends and one cuts.
Well, I remember Bob Jones making similar comments in regards to where Labor's and they basically fill all its buildings up and basically stuff like this. And yes.
I'll tell you, we've seen a bit of a mad rush of people coming back into the office. And suddenly you need to be visible, because if you're not visible, if you're invisible, it's like, well, what do you do? So the motorways have gotten a bit busier.
And I mean, in regards to that overall job market, what are you seeing? I'm presuming it's the discretionary income areas, retail, hospitality, maybe tourism, which are getting hit the hardest.
No, well, it's not one size fits all. Tourism is a bit of an interesting one at the moment. So because tourism got absolutely smashed post-COVID, what's happened, even as interest rates have moved up, we've sort of people have prioritised still taking that offshore holiday. So tourism has been a little bit disconnected from what normally happens during this stage of the business cycle, where the holiday just gets parked. And so there's where we're starting to see big hits is you look at all the retail results, which are down, basically 6 quarters in a row. You look at what's coming through the listed companies on the stock exchange. You look at Fletcher Building's results, which is a proxy for the construction sector in regard to what's going on. Someone told me that 200 construction companies have been liquidated in the first quarter of this year. I don't know where that number comes from, but yeah, sectors that do really good during the good times get beaten up and they suffer in the other times. We call them three speed sectors, fifth, neutral, and reverse. And yeah, we're seeing that playbook pan out. But tourism, an interesting one at the moment, where it bucked the trend in 2023, but I think it's going to get caught up in the rip of 2024.
Yep, there's going to be a little bit of pain there. And I believe we've got something about 60% of our mortgages coming off fixed rates over the course of this year. And I was reading something the other day that I think about $110 billion of that is between March and July this year. And we can definitely start to see, I'd be interested in your opinion, probably when we came back from Christmas, there seemed to be a little bit of a lift in the market very briefly around February. It wasn't really being reflected in the media, but the banks got really, really busy for a while. And then the lights have just basically kind of almost just turned out. And the feedback we're having from the rest of the banks and especially real estate agents around the country is that everything's gone quiet and that there seems to be quite a standoff, I suppose, between vendors and buyers in regards to price expectations.
Yeah, so if I go back and you got to go back to the end of 2021 and 2022 and sort of part of 2023, it was a buyer's market. Either the market was too hot, you take interest rates back up, yeah, affordability bites, it's harder to make the numbers stack up, so house prices are down 15, 16%. Yeah, we saw in 2023, yeah, and it was a whole lot of things. Migration was one factor. I think some people started to get a little bit used to interest rates being up around that higher level, but it was becoming so expensive to build a house. Guess what? People just thought, it's more efficient, effective for me to buy an existing house because I can't knock the thing down and rebuild it for the same price. Yeah, so what's called Tobin's Q came in and started to protect the market, and then I think there was a little bit of hope that the market was going to kick on, and we saw late last year a lot of talk about the market kicking on and off to the races early 2024. Yeah, that stuff was never going to fly. Why? Because when you got an inflation problem, you can't have the property market ripping away. You know, the property market's still going to be sedate. And what we're now starting to see is, I think, leg two of the adjustment. And leg two has been driven by economic factors, which are partly a reflection of interest rates. You know, unemployment's starting to move up. You know, I saw the latest REINZ report, and they were putting, you know, a pretty good spin on the fact that there's a whole lot of a whole lot of listings out there. I think there's a reason there's a whole lot of listings is for the obvious reason is that a whole lot of people need to sell. Yeah, so now you're starting to see your buyers are starting to sense another bite of the cherry in regard to, you know, a little bit of forced sales the back half of this year. So people are getting their gunpowder ready, just thinking, yep, I'm going to be patient here. I think there's another sort of, yeah, get another crack at this because your days to sell are still above average. Yeah, so when you got days to sell above average, yeah, it's still a buyer's market. And yeah, the investors are still not back in the market because you can't make the numbers stack up at the moment. If you don't have the investors back in the market, you don't see that price tension with the first home buyers. Yeah, so it's pretty narrow in regard to what we're seeing at the moment. Yeah, some of the top exclusive stuff has still got, you know, buyers for the stuff that's unique, boutique, that sort of stuff. But yeah, the market's not kicking on.
In regard, what impact do you think the distortions of something like the interest deductibility is going to have? Because I suppose ever since I've been around property finance, investors in a lot of ways have tended to focus on the, you know, find a property which is a bit run down, try and pick it up at a discount, get in there, a bit of Kiwi DIY, spruce it up, obviously improve basically both the equity position and the cash flow, and then try and recycle and go again. And we noticed as soon as Labor announced the deductibility rule change back in 21, that changed the investor landscape overnight. Suddenly, a huge amount of investors became minor developers. A huge amount suddenly said, well, we're going to buy new builds simply because of how large a cash flow effect that tax change is going to have. Now, we've obviously getting that reversed, and we're already starting to see the first signs of, say, property traders coming back in, that they can start to sit there and go, there's probably, you know, some of the second-hand market hasn't been maintained as much maybe over the last few years.
Yep.
And they're getting back in kind of that direction. And also because in a lot of cases with interest rates being high, especially in your main centres. You can't go buy a property which cash flows okay. So people are having to kind of create deals rather than just buy them in a lot of cases. How do you see
That's actually a really good characterisation of what's going on. Yeah, because when interest rates move up, you're now taking real risk to make real money. Like when the cash flow of the investment doesn't stack up, you got to do this thing called add value. You fancy that. Buying, holding, and flipping no longer works in this market. It's all about value creation and what you can do to extract a little bit of value. Yeah, the reinstatement of the interest deductibility is obviously going to help, but yeah, you still got interest rates up around 7%, right? And rates this year are going to be up 15. Yeah, the economics of property investing don't look great unless you get something that's a little bit unique that you can add a bit of value to. The other one, which I don't think is acknowledged enough, is the debt to income constraint, right? Because you just do the basic maths, right? Say you buy a property for 500,000 and it's generating 20,000 worth of rent. Times that by 7, you can leverage it to 140,000.
Yeah.
Now, okay, you throw in some other income and maybe you can get it up a little bit more, but there's only so far you can play that card. Yeah, that stuff is actually quite a strict constraint now in regard to where things actually are, what you can do, because we all know what happened for a long time. You'd leverage the hell out of thing, get a little bit of capital growth, and that was your equity for the next project, and away you went, and the train was in motion. This stuff's been knocked on the head at the moment.
Just talking about debt to income, we'll just jump over to that. Is I suppose on one side I see the announcement in the last few days, Andrew Bailey coming out talking about more relaxing around the triple CFA side. So we're removing regulations, and roughly almost at exactly the same time we've got Adrian Orr looking to push a debt to income kind of rule in. And I suppose firstly on DTIs, what do you think the chances are of having the announcement of that implementation next Wednesday at the Financial Stability Report when that comes out? There's a pretty good chance we're going to get it rammed through.
I'm not sure about the timing of it. I've been so fixated at the moment with global markets that whatever the Reserve Bank runs with, we'll listen. But I don't think they're going to walk away from what they put on the table. Owner occupier 6, investors I think 7 was the number. Was it the other way around? I can't remember which one it was. But even if you actually have a look at the Reserve Bank, I think it was today, put out a response to the Commerce Commission's comments on banking. And they doubled down on the need for banks to hold more regulatory capital, right? Which is like, well, maybe that supports the property market because banks get capital relief by writing a home loan over a business loan. And I'm not quite sure it's going to be that great for the real productive part of New Zealand going forward. But the triple CFA modifications, what they did there was practical, it's sensible. We'll see what it looks like in practice. But where we ended up with that piece of legislation was a bit of a joke, to be honest.
You just quickly tell everyone the story. I think you had a talk to someone at MB a couple of years ago when it first got introduced, and story past everyone.
Me being me, I called up the minister's office that was pushing it through, and I said, like, who's leading this investigation that you've announced into the impact of the triple CFA? And they gave me the name of someone at MB, so I tracked this person down and I called them up. And I said, I've just got a quick question, because you're doing the analysis on how this has worked out. And I'm pretty sure the banks told you this was how it's going to work out and you ignored it. But how many people within your small business team, which at that stage was about 60 people, so it was dealing with all small business related issues, including access to finance. How many people in your team have had experience in a financial institution? Oh, I'll come back to you. You call me back tomorrow and says, we've got some really good policy people. That's not what I asked. I asked, how many people have you got with experience who have worked in a financial institution and know what it takes, what you need to do to approve a loan? The answer was no one.
Yeah, we saw it turn the lights out on the finance market overnight when it was implemented. It absolutely, and part of me still wonders if that was planned, because obviously the market needed to be kind of ground to a halt, but it also caused a lot of issues overnight as well.
Oh, there was a great statement by the Bankers Association. I don't tend to, favour some of what the Bankers Association sort of says, but yeah, there was a great comment that said, which part of our report did you not understand? Because we made it pretty clear this will be the consequences of this regulation.
And I suppose, how concerned are you about, especially the debt to income side, restricting capital in the SME market? Because the closest thing I can look to is how the loan to value restrictions have played out over the last decade, and how that's been implemented, and how the banks have I suppose, applied it behind the scenes. And business lending wasn't supposed to be affected, but we've definitely seen those restrictions over time limit businesses' access to capital. Do you think it could have a similar issue moving forward for the business market?
Yeah, so I guess if you think about this through a broad lens, the New Zealand banking sector has become increasingly vanilla, where they like writing home loans, and they're writing less and less business loans. Now, if you look at OECD research, the OECD research makes it pretty clear. Yeah, you get more productive return on an investment where it comes via the business sector as opposed to the housing market. Yeah, so you want to grow a more productive economy so we can all get well-paying jobs so we can afford a home. Yeah, you got to get that balance right between home versus business lending. Now, home lending was 50% of bank lending in 2000. It's now 63%. And most other lending, whether it be commercial or business lending, is pretty heavily securitized by the house. I'll give you just a simple illustration how silly it is. Through Bagger Economics, I called one of my banks and I just said, look, I want a $500,000 facility because I'm going to go shopping for something. Yeah, that's approved. Here's the rate. It was a business lending rate. We'd like a personal guarantee over your home. And I said, you're giving me a business lending rate, but you're fully de-risking what's going on. If you're fully de-risking, then I want a de-risked interest margin. And this is the problem, is that there's nothing wrong with pricing for risk as long as the financial institution is taking risk on the other side. And this is where people don't understand, and we get caught up in the dollar amount of bank profits. We're focusing on the wrong things. Nothing wrong with them making money, but let's make sure that they're taking a bit of volatility, real risk coming through. Like the banks should lose money in the next 12 months. If they don't lose money in the next 12 months, then I think they haven't been taking enough risk during the good times.
We've even seen it go too far, though, that everything has become such a box-ticking exercise that they've lost common sense. Because in a lot of cases, we're seeing there is no risk. We had a situation yesterday with a client who wanted to borrow 10% of the value of his home. Won't bore you too much about the kind of outside business situations, but this is a transaction where the guy's got enough commercial experience, you don't have to worry about him paying it. Previously, banks would have done this type of transaction. Now it doesn't tick a particular box, so they don't do it anymore. And so we're seeing more and more people getting pushed out to the non-bank market, which is more expensive, which of course is dragging money out of the economy because people are having to pay higher interest rates.
Yeah, well, but there's that great corrections ad where you got the banker behind the barbecue.
Yep.
And you got the corrections officer, and then the corrections officer asks, mate, what do you do? I'm a banker. And when you start seeing, those sort of ads take the mickey out of the bankers start to realise that they just don't have the same standing that they used to have. And look, there's a whole lot of stuff that's going on. Look, bankers are getting smoked with compliance. The fact that bankers now don't get bonuses means they're basically disincentivised to take risk and try to do a creative deal. They'll just want to do the vanilla-based stuff. So it's the stuff with well-meaning intent. It has actually had consequences on the other side of the unintended variety.
I'd say I'd say a huge amount of our job for a while was going into banks and developing good relationships with bankers who would actually try and make a deal work.
Yeah.
I still remember a conversation with a business manager at a bank I won't name, who probably about 3 years ago when they changed their rules around how they were remunerated. He used to always do everything he could for certain deals to get it across the line. And he basically came in and said, hey, I'm better just to sit there and just focus on that $50,000 easy top up, because there's no difference for me whether I do a $50,000 vanilla top up or a $2.5 million complex deal these days. There's no targets, anything behind the scenes now with these bankers. And so
there is a difference between the two, because one of them could potentially go wrong.
Yeah.
So you're not getting reward, but you're taking on risk. So they're all incentivized now to run their nice, tidy little books, and get into work each day and go home and not do an awful lot apart from compliance in between.
We very much noticed the quality of the personnel at banks changed, because suddenly the people who were driven high performers, who were inspired by driving, going after targets, they were disenfranchised. They left the banks, and now you've got basically all the rest of the people there who hated working to achieve targets, and they don't have those targets anymore.
Yeah, and what's happened is that you've seen a whole lot of people have left banks and gone out with alternative providers. But we're pretty tough working in a bank at the moment, would be my view.
Yeah, I would agree with that. That's how we're getting some pretty good quality CVs across the desk. There's a lot of people looking to.
they all know the cost cutting's coming before the end of the September financial year end.
Yeah, 100%. In the construction market, just I suppose jumping back onto that, how do you see that kind of playing out over the next kind of 12, 24 months? Are you expecting us to? I remember in the GFC, we lost a huge amount of tradies over to Australia. Are you expecting a bit of a similar situation, or do you think we're in a better position this time?
No, I think we're in danger of making the same mistakes. And one of the things that's really worrying me at the moment is the cancel-nomics theme that's coming out of central government. So I'll give you just an example. Yeah, there was 4.4 billion worth of education building consents that have been issued in the past 3 or 4 years. Now some of them will be silly stuff that they need to redesign, but all of a sudden there's like, I don't know, 350 or something like that. There's a huge number of stuff that's just been put on hold. Now, you can't do that. If you're going to park plan A, you've got to have plan B. It's a little bit like the ferries we've got down in Wellington. You're still going to need the goddamn things. Yeah, so the danger is that this government has jumped on the brakes so much, is that continuity of work that the business sector normally relies on when you go through tougher times, because your private sector stuff dries up during the tough times. So you need that core work coming out of central government. That's evaporating pretty quickly too. The same with local authorities, because local authorities are under a fair bit of pressure as well. So everybody's hit the park button. And the danger is that, and this is what happens within the construction sector, when you go through a correction, well, guess what? You lose the skills. Everybody's off to Australia, and we're seeing those Australian numbers are increasing steadily. We're losing a lot of people aged 20 to 35, your nuts and bolts sort of stuff. There's a lot more people around available for work within the construction sector at the moment, and it's still early days.
So jumping on to a few actually political questions, and just a reminder to everyone, if you want to throw some questions in, we'll go to questions for Cameron shortly. Obviously next month we've got the budget. What are you expecting there? Anything out of the ordinary, or with it being the National Party, they tend to be pretty bland most of the time with these things? Are you expecting it to have any surprises?
No, I think it's been pretty well signalled in regard to what they're going to do. We're going to get some sort of tax relief. Yeah, do I think tax relief is an economic imperative at the moment? The answer is no. I'm a lot more concerned about New Zealand's infrastructure. If you look at what happened during the last national government, they saved money by cancelling a whole lot of capital projects. And what we're seeing is more of that. And it makes your numbers look a little bit better in the near term. but you still got a liability down the track that you need to address. And this is one of the real big problems that the previous Labor government, who mismanaged a whole lot of stuff. But to be fair, they inherited a whole lot of problems they needed to spend a whole lot of money on.
This is the Clark Cullen government you're referring to, is that the one?
No, this is the Robertson Jacinda lot. Yeah, if you look at the roadie network around New Zealand at the moment, it's not just a function of the previous government, it's a function of the government before that. Yeah, because they pushed out the road maintenance program to fund the roads of national significance. Now, yeah, this cancelnomics stuff, yeah, it's starting to bug me because infrastructure is an economic imperative that we need around New Zealand. Yeah, even I just saw the announcement in the past day or so about that $6 billion flood Cyclone Gabrielle sort of package. It doesn't look like that's going to be $6 billion. So they're going to take money out of that, and it looks like they're going to stuff it in people's pockets. Now, that might be fine and dandy, but I'm just not quite sure it's the economic priority in regard to where we need to be pushing money.
Where's that line, though? Because we obviously, the previous government got completely out of control, losing track of basically money going everywhere.
Oh, yeah.
Working groups basically just all over the place for their first term, which basically most of that didn't actually result in much being achieved. Obviously, this government has been voted in with a mandate to cut costs in some ways.
Yeah, cut costs or deliver more effective outcomes. Yeah, so when you get an 80% increase in government expenditure in 5 to 6 years, you can bet your bottom dollar there's a whole lot of fat that's been crept in the system. Yeah, so they're dead right to go after the fat. The problem is that it's a fine line between fat versus muscle. And what we're now starting to see, and you're seeing it from day to day, is that what's front office versus back office, or front line versus back office, and it's a blurred line in regard to where it sits. Yeah, you got to be really careful. Yeah, this is not like a corporate enterprise where you just cutting costs and we'll just get on with it and find a bit of a solution, and odds are there might be a little bit less of a service over here, but we'll be okay. Yeah, you're dealing with the health system here. You're dealing with police. Yeah, you're dealing with Defence Force capability.
I agree with those things, but surely removal of something like the Productivity Commission, which didn't really seem to do anything, it seemed to be more about virtue signaling than anything else.
Oh, there's an organisation that was in La La Land. Yeah, that's an easy cut. Yeah.
And surely one of the issues, I suppose, moving forward is the ability for these type of things to be communicated to the public. And we've obviously seen News Hub fall over, big job cuts happen at TVNZ. How do you see this moving forward from a media point of view? Because my understanding is journalists on the ground, we've got less than half of them now than what we did, say, 20 years ago. So quality journalism is obviously changing. People seem to be buying more and more into listen to blogs or other mediums because they are checking out, because it seems more and more a lot of journalists seem to think that their opinion means everything.
Yeah, just give you a couple of little anecdotes. Look, number one was that the ODT, I think, was ranked number one in regard to news source. And if you look at the ODT, they're a bit traditional. Yeah, they're not about clickbait and going for speed. They put a little bit more substance and less emotion into the stories. So I think people are starting to recognise that. Well, I called someone at Stuff, and this won't name who it was, but when I found out that they got hold of the news, and I said, put a business segment of 10 minutes back into that hour of news. Let's get a little bit of rebalancing in regard to what's going on. It's not just about reporting the news. This sort of stuff is educational in regard to what's going on at the moment. The problem is that news has become one built for speed. It's a clickbait, and it's become far too emotive. And sort of distance itself from some cold hard realities in regard to this is actually how things operate. And you just don't have those old school journalists that are involved at the moment and actually take the time to do the stories. When I was growing up, I taught myself about business. I'd read two parts of the newspaper every day, and it was a sports section and it was a business section. I didn't have a clue about anything else. I didn't care. Yeah, but I would religiously go through the business page and find out what's going on. And it was actually a teaching mechanism.
Yeah, and that's, I think less and less people do that these days. Yeah.
Well, we did, yeah, everything's online at the moment. Yeah, it's not like back in the day, because I was brought up down south, so the ODT had the big list of share price movements from day to day or over the week, what multiples they were trading at. You'd have a bit of a look at some of these old companies, your Wolfson Deals and these sort of outfits, and some of them turned out to be quite bad, but it was a learning experience.
I did the same thing. I used to every Sunday basically buy the 2 different Sunday papers and read it back to front and all that kind of stuff. I don't think I've bought a newspaper in years. And obviously we've all transitioned to what's online, and people's attention span seems to be so much shorter that the content's being created around that. And there's that balancing act, I suppose, between, there's still part of me that sits here and says some of these companies which are falling over, and I do feel for the people losing their jobs, but they are obviously to an extent not creating content that people want. And it's that balancing act between, I suppose, what is in the interest of the public, but trying to have a media which I mean, I suppose who gets to determine that.
Yeah, well, we need contestability in that area. This is the so-called fourth estate, and yeah, the issue is how does it get funded? Yeah, but I suspect if they put a little bit more of the business focus back into the news, and we're not talking about business dominance in the news. Let's just have a 10-minute segment like we have for sport.
Yep.
Let's make it 6:20.
Yep.
And get a little bit more balance into the news equation in regard to what's going on. Yep. I think you start to get people, whether it be sponsors, whether it be people prepared to pay for advertising, when they see those sort of shifts taking place. But it's about that the news has become very emotive. And okay, there's always going to be a few emotive stories from night to night, but we don't need half an hour of that stuff.
100%. So just jumping back onto actually a couple of interest rate questions, and then we'll throw out to questions. Obviously, trying to do projections in a market which is as volatile as it is now is hard. But that's why we got you in the big seat. Is I suppose what kind of speed do you expect rates to decline once that OCR is cut?
It'll be a reflection of two things, like global growth, and the big risk is China. So if we see China get into more economic difficulty, odds are that's going to transfer around the globe. Then you've got the recipe for a pretty aggressive cycle. To me, the bigger thing that people need to think about is what's called the neutral OCR. What sort of OCR do you think is normal? So right back in 2000, that number was up around 5.5% to 6%. Right, so around that, the mortgage rate, 150, 200 basis points, 7.5 to 8 didn't seem that high. Now, the neutral OCR combination of global factors is estimated to have gone down to 2%. So suddenly the new normal for an interest rate was something around 4. Well, it looks like the neutral OCR is now starting to rise. Combination of rising risk premiums, government debt, inflation a little bit more difficult to contain. The Reserve Bank is now saying it's around 2.6. I think it's more likely 3.5 to 4. What does that mean in English? Put 200 basis points on top of that. Maybe mortgage interest rates, when they come back down and we return to equilibrium, the new equilibrium's 5 to 5.5. All right, so we go back down from 7, but 5 or maybe 6 is not 4.
And I know when I first started investing, I think interest rates were around that 7.5% range. People used to kind of aim for that magical 10% yield in regards to residential property. And then I suppose in the last few years, with interest rates just going through the floor, everyone forgot about yield. And we're now kind of going back to that rebalancing act where people actually have to try and remember, they're starting to remember actually how important cash flow is again.
Yep, and it's the pressure from cash flow. And I just don't think people have fully appreciated that across local authorities this year, we're going to see a 15% average rate increase. And 12 months after that, I think it'll be the same number. Your insurance costs. Hey, okay, you get some interest rate relief, but yeah, some of that's going to get gobbled up on the other side. So you look at the investment numbers, and yeah, yields have popped up because valuations have come down and rents have moved and that sort of stuff. But yeah, you're not getting the sevens, the eights.
Surely these rates are going to be going up for quite a while. You just have to look at different kind of councils around the country, and they're all, running to massive issues. That's going to.
Well, yeah, what the finance minister puts into people's pockets, local authorities are going to rip out the other side. Yeah, my baseline for local authorities is that, yeah, the better ones rates will be up 50% in the next 5 years, and the mismanaged ones will be closer to 100.
I remember reading something from the NZ Initiative, and they compared us to other countries, and they said most other countries allow the local government to have more control over spending. And I believe in New Zealand, we're much more centralised than other countries. Is that something you think that needs to change over time?
Yeah, and then the logical one would be to give them a share of the GST take within the region.
Yep.
Something like that. We've got another, but if you ever look at local authority funding, yeah, councils, yeah, way back, previous national government, they used to get about 12% of council income used to come from government subsidies and grants. Yep. Now, under the Labor government, that rocketed up to 18 to 19%. So council income was protected by a lot more government subsidies and grants. You have these various projects, infrastructure funds, housing, all this sort of stuff. I bet you that gets knocked on the head. Right, so all of a sudden you've got another hole through local authority finances, which is going to need funding, and it's at the end of the day the ratepayers pay.
Yeah, there's going to be some pain. So we'll jump over to some questions. Make sure we've got some time for that. Anyone who's got questions, keep throwing it in. So first question is: are we about to witness property prices stagnating for a prolonged period of time, or even dropping, given the high OCR, mass redundancies in the public sector, and state of the economy?
The property market, I don't think will stagnate for a long time. Yeah, over winter, back after this year, yeah, house prices are going to grow at a slower rate than incomes. Yeah, I think it's a moot point about whether house prices physically fall in value. Personally, I think I'm more inclined towards weakness over the next 3 to 6 months when you're seeing the number of properties that have come on the market, and unemployment is just going to create a few more forced sales. So yes, some buyers are getting ready for that situation. A bit of a double dip scenario, but you got to remember within the property market, you've got a bit of inflation protection that creeps in as well. Well, you just can't build a house at the moment for under $3,000 a square metre. In some parts of New Zealand, you've got to be up around 5,000 to 6,000 a square metre. So all of a sudden you look at the value of the existing property in regard to what it can do. And what goes on is that people buy a property and they'll throw a couple of $100,000 at a renovation. And ironically, the renovation market is holding still at the moment, whereas building consents are dropping.
A quick actually question from me that I meant to ask you, referring back to debt to incomes. Do you think that they are going to have a bit of a structural change in properties across the country? Because to me, it looks like places like Auckland, Queenstown, you're probably places where people are tended to maybe invest more for capital growth. That's going to have a real restriction on the capital growth over time. Where could this start pushing people into the areas where the yields are better because they can actually suddenly buy more property? And I again refer back to what we saw with some of the LVR changes back around 2015, where there was a distortionary factor where the loan to value rules were different in Auckland to the rest of the country. And we really started to see Auckland capital flow out to Tauranga, Hamilton, places like that. Do you think that this will have that type of effect on the market over time?
Yeah, you always get the ripple effect. And the Auckland market tends to be the first market that moves during an upswing. Then Auckland becomes too expensive, so lo and behold, people start looking at other parts of New Zealand. And I can still remember what was 2005, 2006, 07. The most rapid growing part of New Zealand in regard to property prices was Southland of Invercargill. And why? Because way back then, it was just absurdly cheap compared to what we're seeing around the rest of New Zealand. Yeah, so capital will flow to where there's the opportunities. Yeah, we saw the previous upswing, places like Tokoroa, Rotorua, these sort of places went nuts late in the cycle.
Yeah. I note you said it's not a good time to invest unless it's a boutique property or potential for value add. Do you have a long-term view on when it might improve for mum and dad type investors? And can I just jump on the back of this and interest in your opinion? While it may not be a great time to invest if you're paying full retail for a property because of the rates, counter-cyclically is often the best time to invest because of if you can buy at a discount. So I'll throw the question to you, Cameron. But to me, I think there will be some great deals around in the next 6 months.
Yeah, well, if you ever look at bank non-performing loans are half of what we saw in 2010. So we haven't seen the stress yet. Yeah, people are telling us that the toughest times in regard to people in arrears since 2017. We've only seen good times since 2017. Right, go back to 2010 and have a look at what takes place. Yeah, so there's always there's a buyer and there's a seller, right? And what you tend to see is that in this set of economic circumstances, the balance of power tends to be in the buyer's hands. Yeah, so it pays to be patient, and if you've got a bit of ammunition, be prepared to fire off a few bullets in regard to some of the cheeky stuff.
Yeah, I've just been working on a deal over the last couple of days. We don't have an updated market value, but it's a couple of Wellington properties side by side that value just over 2,021,000. So they're probably back, I don't know, 1.5, 1.6 now with how much the market's come back. That guy's managed to get them under contract because the vendor's under massive pressure and trying to get out of other projects for he managed to get it for 1.2 and they rent for $1,200 a week. So something like that, there's still going to be some deals around for those who are willing to lock in, as you said, willing to be a little bit cheeky.
Yeah, well, but banks, I don't think are going to want to see a rapidly rising non-performing loan book into financial year end. Yeah, so there's a bit of pressure that's starting to mount. Look, let's get this stuff moved. One we're watching pretty closely is commercial property. The commercial property market's a little bit like the residential market was in 2020, late 21, 2022. The old Mexican standoff, but ultimately it was the buyers that ended up wresting control.
Yeah, and the commercial markets, everything I'm hearing is industrials pretty good still. It's more the retail market, which is spongy. Retail and office.
Yeah, retail office. The industrial is still favoured, but the heat's come out of that as well because there's a lot of supply that's coming online. But you've got some strategic themes there. Yeah, whether you look at logistics, your golden triangle, or whether you think about we could be about to witness the rebirth of manufacturing capability in New Zealand as onshoring replaces offshore. Yeah, so there's some unique secular themes, but even within like office, if you're well located, if you've got a quality, highly sustainable building, you're well connected in with transport, you've got good amenities for staff because staff are not coming back into the office for average amenities anymore. They'll stay at home. They want the quality stuff to get them back into the office. So people prepared to pay a little bit more for that.
My question is around interest rates. Would you say the behaviour of the Fed will determine the behaviour of the RBNZ, or will the RBNZ decide themselves if cutting is required as in purely based on the NZ CPI figure?
No, well, there's a couple of things, right? Look, one, the mortgage rates on offer do not just reflect what the Reserve Bank does. The mortgage rates on offer, i.e. a 1 and a 2 year rate, reflect market expectations of what the Reserve Bank is going to do. So if we go back to the early part of this year, globally, there was a massive theme that interest rates are going to be entering an easing cycle. Where did that come from? It came out of the United States. The most powerful central bank of the world talked about what was called a pivot. Now, if the most powerful central bank in the globe is talking about lowering rates, financial traders think about, well, every other market must be exactly the same. So all of a sudden, New Zealand wasn't pricing in 6 cuts, but we were pricing in 4. Why? Because it was a global thing. Now we've started to see markets have pulled back from that. Yeah, so yeah, what happens to US sentiment has ripple effects in regard to what the markets price in. But ultimately, that could be different to what the Reserve Bank actually does. And what the Reserve Bank does will be 100% influenced, well, not just 100%, it'll be strongly influenced by New Zealand's inflation and growth numbers, but you still got to look at the global picture.
Yep. Any advice for first-home buyers in Auckland with a 10% deposit wanting to make a good long-term investment? Should we be taking a conservative approach or take more risk and push for better location, etc., and new builds versus existing properties?
Oh, I'm not supposed to take provide advice, but yeah, to me, look, yeah, if you're looking at the long game and you want to get involved in property investment, yeah, it's a good sector to be in, as long as you're prepared to do two things. Look, one, I don't think passive investing works in the current environment. You got to be active, you got to be adding value, and be patient. It's still early days here in regard to what's going on.
Yeah, it's definitely a buyer's market, and it's the case of don't buy the first property you see. Take some time and be aggressive with your offers. If the Fed cuts their rates and the US dollar drops, will that force the hand of the Reserve Bank to cut in order to ensure that our exporters don't run into difficulty?
Well, I guess the New Zealand dollar at the moment is 60 cents. If the New Zealand dollar went back to 63, is it going to worry too many exporters? I think the answer is no. And there's another scenario here. What if the Fed hikes and the currency goes to 57, 58? And then old imported inflation comes in. And what's good for the export sector is awful for imported inflation. Yeah, so there's a whole lot of downstream implications in regard to how you answer that question. But ultimately, the Reserve Bank has got a mandate to get inflation to 2%. Right? The key variable in regard to that is non-tradable domestic inflation. So that's the behaviour of the domestic economy. The domestic spending savings pulse. How much money the government's putting into people's pockets. That will hold sway. They'll keep an eye on the export sector. Yes, what's happening across the farming sector at the moment, red meat, is not pleasant. They're tightening the checkbook, and there's some real stress that's starting to emerge, and that will be an inflationary suppressant. But the big game in town is what we're seeing in regard to those physical non-tradable inflation prints, and whether the weakness in the domestic economy manifests in pricing outcomes. To date, we haven't seen it.
Just actually staying on the States for a second. Obviously, you mentioned earlier that you've been focusing quite a bit on the geopolitical and offshore situations. If you were gonna, what are the chances of I suppose, if you were having a bet, do you think the Fed's next move will be a hike or a drop? And I suppose my second question actually would be, we've obviously got an election coming this year, which is going to be interesting. If for example Trump gets in with his policies, what will that influence? I suppose what influence do you think that could have on what the Fed decides to do?
All right, so a couple of things. I'm not in the camp at the moment that said the Fed needs to go again. I might change my mind if I see another strong inflation print, the PCE deflator on Friday night. Just the United States economy has been remarkably resilient, and inflation is stabilised now at 3.8 to 4%. We're only getting it down so far now, so it looks like they might have to give it another kick, which is never easy in an election year. In regard to the United States election, a couple of things, and it's not just the American election, it's Indonesia, we've seen Taiwan, I think Mexico's up, India's a big critical one as well. we're sort of watching, is democracy being challenged around the globe?
Yep.
You know, it's quite frightening that America's going to the polls with, you know, old Sleepy Joe and Donald. Now, no matter who wins that election, I suspect there might be a whole lot of Americans on the other side of the political fence might find New Zealand and Queenstown quite a nice place to be. So ironically, we could benefit out of, you know, America. We've got a big problem here in New Zealand in regard to division. Yeah, but our division pales in significance compared to what we're seeing in America. It's amazing to watch and to think about. They're our global superpower and what's going on there politically. You know, I get the sense, I think a whole lot of Americans are just going to say, oh, I'm out of here. You know, get me somewhere afar. And little old New Zealand looks pretty good. And you see things such as Queenstown with its tech hub. And you think, okay, yes.
Yep. Given the new government has plans to open up more land for development through zoning changes, as was done in Canterbury following the earthquakes, what effect do you expect this to have on property price, either inflation or deflation over the medium and longer term?
Right. So if you ever look at, straight away after the Christchurch earthquake, because they effectively fast-tracked and they released a whole lot of land, the Christchurch market was the most well-behaved property market in New Zealand for a number of years. Why? Because we saw a supply-side response. Now, ultimately, what we also saw later part of the cycle was because Christchurch looked so cheap compared to everybody else, all this capital suddenly pounced into Christchurch. So Christchurch was that last cab that really started to move. Yeah, but you're not going to restore affordability into house prices unless you're releasing a lot more land. And there's a reason a whole lot of people in New Zealand, you've got to look at internal migration figures, not just external. The flow of people within New Zealand. Auckland loses 10 to 15,000 people per year. You just go have a look at what's going on down in Cambridge. Wellington City is losing people to Kapiti. We're losing people over to Masterton, etc. Christchurch to Selwyn, Waimakariri. Hamilton loses people. Hamilton City down to Cambridge as well. People ultimately, they want their little piece of land. Yes, intensification takes you so far. But part of the big, one of those big Kiwi attributes is you just want a piece of land for the old kids to run around and play a little bit of backyard cricket.
The DTI is going to make it impossible to buy them and 10 houses. So you have a retirement plan for the future. Aussie Island investors are lucky if they own 1 to 2 investments, rentals on average with their current DTI. How are you today going to set themselves up? The one thing I'll say before Cameron answers is I am still expecting the non-bank market to come in and provide quite a few solutions for a while on that DTI side. I know of 3 who are looking to create products, but they can see they've had enough of I suppose, warning that they're coming in. And the DTIs aren't really going to bite too much for probably 12, maybe 18 months until the interest rates drop, because how banks assess mortgages at the moment is actually more onerous than the debt to income criteria. And I think that's part of the reason the Reserve Bank's wanting to jam it through, is they push it through now. No one makes what takes much notice until a bit further down the track. Sorry.
I guess there's another way to think about this. From the early 1990s to sort of the 2022, average increase in house prices per year, 7.3% every year. Income growth, 4.5 to 5. So people are making a lot of money. And when you get in that sort of regular house price growth, that equity gains basically fueling, your equity into the next property, which you can then leverage. But if you look at what were the consequences of that, financial system of the Reserve Bank basically said enough's enough. It's getting too risky, so we got to hold more capital, or we're now going to bring in a DTI. It drove income inequality. It's driven wealth inequality. It's driven a bigger gap between the haves and the have-nots, and distortions within the market. So I guess if I sit back and think, just through a common sense economic lens, where should house prices go for the next 10 years? Positive, but probably somewhere slightly below the rate of income growth. Yeah, so income growth, let's say it's 4.5. Yeah, maybe house price growth is going to be 4. Yeah, 4 is still okay, but it's not 7.3.
When is a good time to buy off the plan or new property for investment? I think we were kind of discussing that a little bit earlier at the moment. I'll let you answer that, kind of, Cameron. I mean, to me personally, I would be buying off the plan at the moment, and we're seeing that also reflected by developers are really struggling to buy off the plan at the moment, or to start to sell off the plan.
Yeah, I guess when you go through tougher times, I like to physically knock on what I'm buying to see what it is.
Make sure your developer's solvent.
Yeah, look, haven't been cutting the corners in regard to what's supposed to go into the stuff is actually going into the stuff, and what's the thickness of the walls, how much insulation's actually got in it. In regard to, you have a look at a whole lot of these bloody boxes around, and you suddenly wonder about what are these things going to be like to live in regard to how good's the insulation, in regard to hearing the screaming from the neighbours next door.
Yeah. That one is, looking at what's happening across the ditch, the Australian property market is generally still tracking upward, and that I'll definitely agree with Tony here, who's asked the question. I was having to talk to a mate in Sydney yesterday, and he says that they're taking along quite nicely. This does not make sense to me, but what is your view as why this seems to be happening?
Australia is a little bit later than us in the economic cycle.
Sydney
go
before Auckland, doesn't it? Often.
Yeah, well, Australia lifted their official cash rate far later than ours. And it also sits lower than ours. But if you ever look at the Australian domestic economy is struggling. It's actually getting beaten up, but it's getting beaten up less bad than what the New Zealand economy is. What's also going on in Australia is that they've seen big outsized migration gains just like New Zealand. Now, I haven't looked at the numbers, but I suspect their inflation mix might be a little bit more favourable, the purchase of houses over the rental market. Yeah, the migration mix in New Zealand has been definitely more supportive of the rental market as opposed to the buying of physical houses.
No, fantastic. We'll wrap up here. Just want to say a big thank you to Kevin for coming on tonight. Just a final probably couple of comments is because we are seeing, I suppose, in some cases, some people are feeling a bit of mortgage pain. If you are wanting to have a bit of a chat in regards to that with myself or one of the team, if you're kind of feeling the pressure on these kind of rate hypes, get in contact and we're happy to have a chat. On the flip side, we're definitely starting to see some investors who are wanting to get their powder dry and kind of get ready under the presumption that there could be some pretty good buying opportunities coming up. So if you want to have a chat with anything, just kind of get in contact with Ryan and myself. And again, a big thank you to Cameron. Cheers, mate.
All the best. I like the artwork in the background too.